After quite an emotionally charged handful of trading days following the election and Trump getting reelected to become ultimately Mr. 47, the stock market is finally cooling down, as we can see clicking into my portfolio tracker, which, just by the way, if you're not already using a portfolio tracker, I highly recommend Gitquin. Placed a link down there in my description and pinned comment for you. But either way, we could see that just after the election, market participants were just supercharged. The market launched to some really high highs, bringing ultimately my portfolio to over $230,000 at one point this past week. However, with the news now really becoming a thing of the past, and investors, I'm sure, are selling for some profits, we can see that just from my count alone that we are now on the descent, which is actually pretty good, what I like. I'm now personally sitting on roughly $228,388 as of this recording. Now, personally, I think we're going to be in for one heck of a ride in 2025, and in order to prep for that ride, I'm taking all the necessary action steps now by asking myself some deeper questions, like what's my end goal? How should I really be investing in 2025 to get there, and ultimately why I'm not moving faster? So for today's update, I'm going to be sharing the two stocks that are ultimately getting the boot for my portfolio and share with you what I bought as well this past week, just considering I don't really like to buy when the market bulls are running loose and on a buying spree with their emotions. I didn't really buy a whole lot, but before I do, I want to go ahead and actually just pop open Gitquin once again so you all can get a better feel for what's underneath the hood of my portfolio. With that, on the top right-hand corner, you're going to see that we have this button, Show More, so we're going to give that a click. We're going to get the inside scoop now here and see that I am predominantly invested into ETFs, with 44% of my capital allocated into just three funds that we're going to cover in a moment. And then I get into individual stock positions. I have some dry powder here as well, with cash at 12.5% of my portfolio, which I'm also going to discuss again in greater detail soon. And if we click here into sectors, we're going to find that my portfolio actually is heavily weighted into technology. Now, most of you may be asking the question of like, what? This is a dividend investor. But regardless, well, technology is all about growth, and considering my investor profile, I'm a 30-year-old investor, this makes sense. Then from tech, I get into consumer discretionary at roughly 10% of my portfolio, and healthcare at a little over 8.8% of my portfolio. Both of these sectors really give me some more balance and reliability, but then I tap into industrials here at 5% of my portfolio, consumer staples at 3% of my portfolio, followed by financials at almost 3%, real estate coming in at 2.8%, and energy at 1.1%, then some slivers of utility and materials. Now, getting a little bit more position specific here, we can see that the foundation of my portfolio, or rather the biggest position in my portfolio, is the S&P itself, with Vanguard's VOO. So I really can't lose, and that makes up almost $53,000 worth of my portfolio, or 23%, whereas the second half of that foundation is made up with Vanguard's tech ETF, ticker symbol VGT. Now that makes up over $30,000 worth of my portfolio, or 13%, creating, in my opinion, a true fail-safe, stable investment foundation. Now, as previously shared, I have this big cash position in my portfolio, and I'm not just sitting on this $28,640. That's roughly 12% of my portfolio's weight. I am literally waiting for a golden opportunity to really double down and invest it. However, I still dollar cost average into the S&P every single week with this lump sum. From here, we get into Apple, the largest individual position in my portfolio. That's followed up by Google, which they both shell out a smaller dividend, yet their growth firepower is unmatched. And they come in upwards of 12% and 10% of my portfolio, respectively. Then we have what used to be a big part of my investment foundation, but since no longer, the Vanguard Total Stock Market Fund, ticker symbol VTI. That's a quality fund that really tracks the entire market, so you really can't lose. Before I spread into United Health, the stock in focus, at almost $12,000. And if the stock continues to fall, I'm going to be loading up on it once again. Now, another stock in focus for me is Visa. That's coming in at roughly 3.4% of my portfolio, but you should see this one really growing in the new year as well. Then we have Tesla, that's neck and neck with Realty Income at $6,600 and just over $6,100 respectively, before tapping into Lockheed Martin, as well as McDonald's and Coca-Cola. So not a huge portfolio. However, I mentioned two of these positions will ultimately be booted. So I want to jump back on screen with all of you to talk just a bit more about these two holdings that I'm going to be kicking out of the portfolio and why exactly I'm cutting them out. And perhaps I'm going to start with the one shocker here, the dividend stock you would least expect, Realty Income. This is the one monthly paying dividend stock that literally every dividend investor loves. And how could you not? I mean, with that monthly dividend, it's insane. But I think most of us are honestly fooling ourselves by holding it. And just hear me out here. Of course, it's totally dependent on who you are as an investor and your investor profile. But if you're younger and not necessarily in need of monthly dividend income, I am just not so sure that this is your real dividend treasure chest that you should be heavily invested into. It's more of a dividend distraction. So let's click into the stock chart where, yes, we can see that it's at least up on the year nominally, even after recently sliding from interest rate cut news that's not so favorable. But even on the 5-year here, we're going to see that the environment hasn't been so friendly towards realty income, meaning it hasn't really been performing. Now, just think over the last 5 years, that's a lot of time. A young investor could have gone with, say, a United Health, which appreciated by over 120%, or even a play like Visa that appreciated over 70%. And while we're all hyped up about realty income's dividend yield, young investors really actually just got the short end of the stick here in terms of an ROI. Now, of course, realty income is a great dividend stock. I'm not denying that, so don't get me wrong. We can click into Simply Safe Dividends to see a sound dividend safety score here coming in at an 80, a higher dividend yield at 5.62%, as well as some healthy metrics for a REIT like their payout ratio and an impressive dividend history. And then we can also scroll down here to something I don't really love as a younger investor, which is this growth rate coming in at only 5%. So what you will ultimately see in due time is realty income getting the boot and being sold out of my portfolio. And yes, in fact, I am gunning for growth, which ultimately means investing purely for what we all should be investing for: total return. Now, another dividend gem that I am not here to say is a terrible investment by any means, but nonetheless, not a great investment for me personally, is CocaCola, which once again may shock you. And I wouldn't be surprised if your jaw just dropped. I mean, this is a stock, after all, that every dividend investor knows and very much loves and can appreciate, right down to Mr. Value himself, Buffett. But when I understand my investor profile, it really doesn't make sense for me to be invested so comfortably in Coca-Cola when I could be making a much stronger ROI elsewhere. So clicking into the stock chart, once again, you're going to see that we have Coca-Cola here that's performed pretty well this past year. Heck, even better than realty income. And over the last 5 years, a standout opportunity depending on your investor profile. But can you get a better total return? Absolutely. So if we plug in United Health and Visa, as we did with realty income, we're going to see that once again, we have two powerful stocks that are going to perform for me as a younger investor much better. So expect my portfolio to dwindle down in terms of a holdings count, but continue to ultimately increase in capital in certain holdings that will ultimately boost my total return. Now that's most important. And as for my one buy that I made this past week on a very emotional week, well, I simply stayed tried and true to my S&P 500 commitment to buy a share a week, whether the market's high or low. So I went ahead to do just that, buying another share of VOO for $546.98. Now, investors, as the year is winding down, which is crazy to even say, I want to know what stocks you're thinking about selling, if you're thinking about selling, or what exactly you're planning to do in 2025 and how your strategy is evolving. Let me know down there in the comments. Check out this conversation I just had with good old Ryan Williams, speaking totally unscripted about our investment decisions and how we think. Don't forget to subscribe to the channel, and with that, I'll catch you in the next one.